Why do all millionaires follow the value investing rule? You must wonder why all millionaires follow the value investing rule. Do they even get a profit from such an investment? Don't they go to a loss by investing in stocks that are being traded at lower prices in the market? And if you want to understand the significance of value investing, you must watch this video all the way through. We'll be answering all your queries. Each of us has our own set of advantages and disadvantages. Even without a trust fund or inheritance, self-made billionaires are aware of how to effectively leverage these advantages to accumulate significant amounts of wealth. These smart individuals know how to navigate the complex financial landscape, starting from nothing and gradually accumulating money. You can become a millionaire or even a billionaire using a variety of financial tactics rather than just starting your own business. And this is where, according to Millionaires, the value investment rule enters the picture. Numerous millionaires have demonstrated the value of adhering to the value investing rule. The most well-known millionaire investors all adopt the same strategy: value investing. Value investors include people like Mario Gabelli, CEO of Gamco Investors; Seth Klarman, CEO and portfolio manager of Baupost Group; Mason Hawkins, founder of Southeastern Asset Management; and Warren Buffett, CEO of Berkshire Hathaway. Although they may have followed different roads to success, their value investing approaches are comparable. Now, some of you must be wondering what the value investing rule is. The phrase value investing was created to describe a technique in which investors attempt to purchase bonds, properties, stocks, and other assets for less than their actual value. These clever investors purchase value investing to discover an asset's underlying value and practice waiting until they reach a price where the asset might be acquired for a lot less than its intrinsic value. Given that it's a little too late for an investor to surf the wave once it's already on the rise, value investing entails assigning little to no attention to trends and current exciting items. Technically, it entails purchasing a highly valued firm that you can continue to own for the ensuing 10 years without fear of going bankrupt. These businesses include, for example, Apple, Gillette, and Coca-Cola. The truth is that if you don't adhere to the money principles that the majority of millionaires follow, you won't be able to earn a fortune even if you spend all of your time working non-stop. You can become a billionaire without founding a multi-trillion-dollar business. It is evident from Warren Buffett's career that one does not need to own a multi-trillion-dollar corporation to achieve financial success. In actuality, unlike fellow tech titans Elon Musk and Jeff Bezos, Buffett wasn't involved in any tech firms or groundbreaking ideas. Instead, he was so intent on making investments in businesses in which he firmly believed. Larry Page and Sergey Brin, who founded Google in the late 1990s, were so eager to sell it off to a technology giant that they were prepared to strike a deal with Yahoo for just $1 million. Since Yahoo was already on the internet at the time, they rejected the founder's offer because they didn't perceive the value that Google could provide. Today's popularity of Google is comparable to that of Yahoo in the past. Even though Google didn't meet Yahoo's requirements, Stanford professor David Cheriton saw potential in the company's algorithm and invested $100,000 in it. The value of his $100,000 investment as of right now is greater than $6 billion. Cheriton aimed to identify value behind every firm and bet in the long run rather than picking companies at random, which allowed him to turn his $100,000 investments into billions. This little endeavor merely highlights value investing's core principles. The similar pattern Cheriton followed can be seen if you look at the businesses that Peter Lynch, Warren Buffett, and Charlie Munger have invested in. The notion that assets are fairly valued and markets are efficient is rejected by value investing. When unproductive businesses are valued highly, this inefficiency manifests itself in one aspect. That is not based on a security analyst, but rather on expectations of future profitability. This approach, which Buffett is most known for, was taught to him by Benjamin Graham, who's usually regarded as the originator of value investing. The Intelligent Investor and Securities Analysis are two of Graham's major works on value investing. The latter, according to Buffett, is the best investing book ever produced. Buffett first noticed Apple in 2016 because of its ability to persuade other companies to price their products far more than Apple does. In the last 5 years, the value of Apple's stock has tripled. This merely demonstrates the immense value that Apple possesses. The issue with many investors nowadays is that they choose companies based on their appeal and the person endorsing them rather than digging deeper into the business's foundation and technological capabilities. As a result, when you question typical investors about their portfolios, they hardly ever mention the equities they own. Although investing can legitimately lead to financial success, doing so carries a high level of risk. Many would-be investors have experienced financial losses when investing in the stock market and the newest form of investment, cryptocurrency. The key now is to understand how to choose a company for value investing. Companies with robust balance sheets, such as those with no debt, that are trading for far less than their intrinsic worth, are what billionaire investors like Hawkins and Buffett search for. Fundamental analysis is used to determine an organization's intrinsic value rather than their market value. Some investors who believe value investing excludes growth may be perplexed by the fact that they also search for firms with the potential to develop over time. Value investing is not a fast track to wealth. Purchasing a firm that is expanding, but whose shares are priced below their intrinsic value, offers the best of both worlds. The same pattern can be observed in any business that Warren Buffett, Charlie Munger, or Peter Lynch have invested in. Buffett seeks out businesses with such high value that he can buy the shares and put them away for the next 10 years. Consider brands like Apple, Gillette, and Coca-Cola. None of his stocks will be sold according to him. Some people have doubts about his investment skills, but the fact that he created a fortune of $100 billion only by choosing the proper firms to invest in tells a lot about the effectiveness of value investing. Value investing involves buying stocks whose valuations are significantly higher than what they are currently trading for. Warren Buffett recognized in 2016 that Apple is such a strong brand that it can essentially sell anything for a larger margin than any other tech business. Additionally, Apple's value has tripled during the past 5 years. You might be wondering how they protect themselves from harm. These millionaire investors make decisions after carefully weighing all the risks, including potential losses. They always leave room for error. The idea of a margin of safety dates back to the concept of intrinsic value, and investors who use one typically only buy securities when the market price is much below the underlying value to reduce the risk of loss. Depending on their risk tolerance, investors can apply the margin of safety to any sort of investment. Buffett has always thought about his area of expertise. The idea that investors should purchase what they're knowledgeable about is based on the concept of a circle of competence, which is the topic area in which the investor has certain abilities or expertise. They don't finance every project. By focusing their investments on sectors they are familiar with, investors reduce their risk. Value investors also consider factors other than just the numbers, such as the company's management team and the values and ideals it upholds. Buffett typically meets with the management of a company before investing to ascertain who runs it. You probably shouldn't invest in stocks if you can't do all that. To sum up, Buffett proved that we were all mistaken when he said that the only way to become a billionaire was to find and grow your own business. He demonstrated to us that making $100 billion can be achieved with just one smart investment, without the hassle of managing business concerns. If a stock's true value is $300 and you purchased it for $200, you'll gain $100 simply by waiting for the stock's price to rise to its true value. Additionally, the business may experience unanticipated growth, which would enable you to increase your income. Don't forget to refrain from investing at record highs. Okay, people, we hope you now know the importance of value investing and how millionaires benefit from this rule. If this video sparked your interest in value investment, then give a thumbs up to this video and also share it with your fellows who want to do some investing. Also, if you want more great content, then subscribe to our channel and we'll be back soon.